Well, if you could look at last year's Jackson Hole, Jeff, he said there was slack in the labour market, there'd been no wage spiral, and inflation was transitory. So the glib part of me thinks, does it really matter what he says, because he got it completely wrong? I also think it's interesting that everyone's hanging their hat on the expectations when he's told you there's no forward guidance anymore. And I think he also said earlier in this year, he doesn't really know what the economy is going to do. And by the way, I'm not having a pop at him for that. I'm just saying there's so much that appears to be hanging on something when absolutely nobody, including them, really know what's going on. I think that's the brutal truth. I mean, every three things he got wrong last year. So why is everyone hanging their hat on what he's going to say this year?
So where does that leave us in terms of how you build a portfolio that reflects the risks on both sides, Peter?
The next part of the risk, I mean, you've had a nice bounce on the growth stocks, and it's understandable. It's fairly normal, standard procedure. I think the truth is it's the margin compression that comes next, and that's still a combination of energy costs for most. I mean, the US has done a better job here than obviously the rest of us, but are challenging. You've got demand, which is inevitably going to weaken as disposable incomes have come under pressure due to these inflation issues. So for corporates, you've had the nice bit. You've had the costs haven't been rising for the first half of this year while they've been able to punch prices through. The second half of this year and into next year is the reverse. The costs have gone up. And if anything at the margin, the ability to pass that on will fade. I mean, the year-on-year effects of inflation are going to fade. So you get into the stickier part of the equation for companies, and therefore it's going to be a real story, I think, for the second half of the year. Margin compression, earnings are still too optimistic, without a shadow of a doubt. I mean, if you haven't been able to make money in the last 6 months as a company by just pushing through 5 to 10% price increases, I've no idea why you're in business. If I hear one more person tell me earnings have been good, I think I'm going to be ill. It's nominal growth. It's not real growth. It's not real volume growth. And I think that's going to be the challenge. And that therefore shapes the kind of portfolio you put together. And it goes back to, I think I've been boring everyone with it for a while. It's still that relative value and income trade. I don't think that's going to change. I think the resilience in cash flows and balance sheets will matter to a degree, but the obvious targets remain, I'm afraid. Energy, yes, defense stocks for the long term. And think about inflation proofing still. Best way to have inflation proofing largely is to pay good paying dividend, preferably growing dividend kind of stocks, and favouring sectors that I'm afraid are going to be the medium term winners of this world we're in, which is labour is tight, wages are going up, and you want to look for companies that are either uniquely placed or can keep pushing those prices along. I think that's the world we're in.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.